Mohamed, you and I have been in contact over the last few days about what's been going on in this market turmoil. What do you make, I know you're not day to day, but what do you make of today? It looks like we might be giving up some of these gains already.
I think what's happening today is people have gone from asking, is the Fed willing to do something, to will the Fed be effective? And that's a really important distinction. So no one questions that the Fed can be effective in controlling the yield curve, especially the short end. And that's why you see the treasuries rallying. Nobody questions that the Fed can be effective in flooding the system with liquidity. That's why you see gold surging. That's why you see the oil weaker. Where people are asking questions is, can the Fed influence the economy? Are we in a liquidity trap, or can the Fed actually influence the economy? And here there's a genuine question mark, and that's why the equity market is selling off, because there's questions as to whether not is the Fed willing to do something, but will the Fed be effective when it does this?
Well, Mohamed, what do you think? Will it be effective?
I think the Fed is a bridge. It's a bridge for very slow moving, in fact I call it glacially moving, entities in Washington, D.C. that should finally step up to the plate and deal with the structural impediments to growth. The question is, will this bridge work? As we found out with QE2, QE2 ended up to be a bridge to nowhere in terms of its economic influence. So it didn't put us on the path of higher growth that we were hoping for. So the key issue is not whether the Fed can provide a bridge. It can. The question is, where does this bridge lead to? And that's not in the hands of the Fed. That's in the hands of the other agencies in Washington who, until now, have been asleep at the wheel.
Right, but the bridge, though, is what? The bridge to Washington is to more austerity, or the bridge is to more fiscal stimulus?
Well, the first thing about the bridge was to calm down markets. It was very important that the Fed act as a circuit breaker. Had we had another bad day yesterday, another 200 to 400 point decline in the Dow, you would have seen this vicious cycle, the negative feedback loop between market technicals and fundamentals. So the Fed wanted to be the circuit breaker, and the Fed succeeded for one day. The bridge has to do with structural reforms. And Betty, you've heard me say this. It's about housing. The housing market isn't functioning properly. It's about the labor market. It's about bank lending to small enterprises. And it's about medium-term public finances. Unless we move simultaneously on these issues, the Fed will be a bridge to nowhere.
Mohamed, if we see the markets, for instance, a sell-off as much to the degree that we saw on Monday, is this going to prompt the Fed, do you think, to act even quicker than it might have?
I'm not sure the Fed can act quicker. And I'm not sure the Fed will want to do something again so close to the FOMC meeting. If anything, we may get some signal at Jackson Hole. Our concern, Betty, is imagine a child at Christmas picking up a package and shaking it. And then you have to open it. And you're not quite sure what you're going to find inside. The markets are going through massive volatility. And it's not surprising, because we are in uncharted water for the economy and for policies, and therefore for markets. So sentiment is a big issue, and you get these massive moves. Just like yesterday, we had a massive move in the last hour or so of the session. Once it starts moving, it moves. So I think people have got to be very careful, recognize that this volatility is a function of the fact that there's lots about the economy, there's lots about policies that has been unthinkable until now, and suddenly it's reality.
Mohamed, it's John Erlichman. What seemed unthinkable to some not too long ago was the 10-year yield getting towards 2%. We saw it yesterday, and this morning it's happening again, getting back towards that level. You've now got about 3/4 of the stocks in the Dow Jones Industrial Average that actually pay you a dividend yield that is higher than what you'll get for putting money away for 10 years. Are you concerned about the current level of treasuries?
You know, we're here for a couple of reasons. First, the fundamentals. People are revising down quickly the outlook. Even the Fed used some pretty strong language to talk about a gloomy outlook, and in addition said the baseline involves more risk. So the first thing is that it reflects the economic situation. Secondly, you have the Fed that tells you, I'm not going anywhere on rates for at least 2 years. So that pulls the curve down. And thirdly, don't forget that given what's going on, there's a lot of people that are worried not about the return on that capital, but the return of that capital. And therefore, we're seeing a flight to quality that's impacting everything, including treasuries, but also including gold, including the Swiss franc. So all these factors are coming together and resulting in these dramatic moves.
Mohamed, this is Michael. You mentioned Jackson Hole. Do you expect Ben Bernanke to put QE3 on the table? And if he does, what do you make of the 3 dissents yesterday? Some people say it makes it harder for him to get QE3 across, and others say it just shows that he's got the votes and he can ram it through no matter what.
Michael, I think the 3 dissents are important. I mean, they speak to something that the Fed doesn't like. The Fed is very collegial. It likes consensus. And therefore, to have 3 dissents, and this is the first time we've had it since 1992, is meaningful and consequential. However, the Fed finds itself in a really uncomfortable position. It knows that there's a risk of recession. It knows that that risk is going up. It looks around and sees that other agencies aren't moving, and it continuously asks itself the following question: should I carry even more of the burden of adjustment, even though I have largely ineffective and uncertain policies? So far, Mr. Bernanke has said, you know what, I can't just stand on the sideline. The problem is the more he does and the more outcomes disappoint, the less credible the next move is. And that is the really hard discussion that's going to be going on in the Fed ahead of Jackson Hole.
Mohamed, Mike had this question as well, which is, you were talking about the effectiveness of the Fed and what they can do. It raises the question then whether or not we might see in the near future some sort of concerted global action by central banks to try to bring rates lower, to try to stimulate the economies that way. Do you think we'll see that?
Well, we're seeing it, Betty. I mean, remember the ECB came out on Sunday with a very dramatic statement, especially for a Germanic central bank. And just like the Fed, it is trying to provide a bridge for other agencies. So in the case of the ECB, it was about buying Italian and Spanish bonds, which was an anathema for a central bank previously. So what we're seeing is the central banks are trying to get the act together. But we have to recognize what they do is necessary but not sufficient. We need other agencies, whether it's in the US or in Europe, to get the act together. So it's the same problem in Europe. It's the same solution potentially as in Europe, but we need to see them acting. So it's not just a question of central bank coordination. It's much wider than that. It's about all economic agencies coordinated both within countries and across the major regions.
Mohamed, in all the editorials I know that you've been writing, throughout this turmoil, you've always noted that there's silver linings in all of this, right? In this volatility, what exactly is the silver lining here?
I think the silver lining is twofold. First, hopefully it's a wake-up call. Societies tend to wait for crises before they move. It's not great, but that's what they do. That's what we do as humans sometimes. We need a crisis to get us moving, to get us out of what's called active inertia. Active inertia is where you think you're doing something, but in reality you're not, because you're simply doing more of the same when you need to change course. So the first silver lining is that hopefully this will be a wake-up call. And boy, do we need a wake-up call given the unemployment situation. Secondly, it's also a reminder to markets to be humble. Yes, bet on what the Fed controls, bet on what the ECB controls, but be careful when you start betting on what the Fed can influence, because its influence is much less today than it was in the past, because transmission mechanisms are broken.
Mohamed, let me just finally, let me ask you this bluntly. I mean, I know you're running the world's largest bond fund. Would you get out of the way of equities right now, seeing what's gone on?
I would stay on the sideline. I think there's going to be lots of opportunities. They're going to start being very selective. They're going to be higher up in the capital structure. They're going to include companies with solid balance sheets, and there's lots of them out there, and dividend payers. In emerging economies, they're going to include companies that are much more domestically oriented than export oriented. Okay. So we're going to see opportunities as we go along, but be selective at first, because you're going to have a better entry point into index-wide exposure.
Mohamed, great to have you with us. Thank you for sticking with us through this past half hour. That was Mohamed El-Erian, the CEO and co-CIO of PIMCO.